All right, then. Well, let's segue into our next series of topics that will come back to the idea of July and worsening the situation. But we're going to talk about the middle of September. For new members of our audience, you may think, what? Who cares? But for regular listeners, you have been waiting all summer for the middle of September. And Jeff, just give people an explanation of what is this bottleneck. And for anyone who wants to read this article, it's called COT Black Closing In on Mid-September. What about oil? And you posted it on the 8th of September. Jeff, collateral bottlenecks, why do we care about September?
Well, there's from very early in the U.S. History and economic history, there have been seasonal flows, big seasonal flows. In fact, one of the first tasks of the Federal Reserve when it was first when it first showed up in 1913 was to manage those seasonal flows. You have massive flows of money out of the economy. You had goods that seem to exhibit very seasonal behavior, and because of that, money also exhibited very seasonal behavior. I mean, you just think about the Christmas shopping holiday, for example. That was always a big part of the calendar, and so the Federal Reserve, even it's one of its earliest jobs was to make sure there was enough currency in flowing through the system as people were spending money on goods and gifts for Christmas. So there's always these seasonal quirks that exist in the monetary calendar, except they may have undergone some modern updates and things, but for whatever reasons there's these seasonal low points where liquidity becomes tight. And one of them happens to be the middle of September, which is 2 weeks before the end of the third quarter each year.
I'm going to pull up a graph now because just this week, the St. Louis Fed sent out a scanned copy of a commissioner report from the beginning of the last century that shows those flows exactly. Let me pull it up here. Can you see those, Jeff? So what we're looking at is from the National Monetary Commission, New York Clearinghouse Banks, monthly movements of cash to and from the interior of the country. And so we're looking at pie charts, but the pie charts are broken up. They're not an even pie chart. And what we see is that the brown pieces are money moving into New York, while the kind of the dark brown pieces or the black color means money moving out of New York and into the interior of the country. And Jeff, I know you're not going to be surprised, but September shows up even back, a century ago before the Fed came into being.
Yeah, that makes sense, right? Because that's the harvest season. And so the interior of the country grows a lot of grain and products and agricultural products, and those goods get shipped to market, and then therefore payments have to go into the interior to pay for all those goods going into the market, especially to New York, where because a lot of the agricultural products, and not just but industrial products too, end up heading overseas. And so you have a global payments issue in dollars that goes along with this interior flow of money to New York, outside of New York, as well as Chicago to a certain extent too.
And just people have a hard time believing that sort of seasonality can still exist. I guess people assume that we've broken free of the seasons, that we're so modern, that we're not connected to it. But it's always there. It's always part of nature, and we can see it. We've got evidence of it. You've been writing about it for years. But in this article, you look at it through the lens of oil. So let's look at that. What are you seeing in the supply and price of U.S. domestic oil production?
Well, for one thing, oil production has been severely curtailed, which makes sense because we shut down the economy. There's less economic activity. People aren't driving around. There's less use for oil. So there's less demand for oil. So you would expect supply to eventually adjust to where demand is. And so that's happened. Whether you look at the U.S. EIA's numbers or the Federal Reserve's industrial production figures, what you've seen is about a 20 to 25% decline or reduction in U.S. supply of crude oil. And it's not just the United States either. Globally, the supply of crude oil has been severely curtailed, again, for the same reason. So all around the world, there is much less oil flowing into flowing out of the ground and into the economy.
And therefore, we would expect, I suppose, prices to increase because there's less supply. But you see that that's not happening. And you also look at it from the point of view of contango and backwardation. So, Jeff, how long has the oil market been in contango?
Well, that's, I think, the big message here is number one. I mean, first of all, as supply has been curtailed, why are prices dropping again as we move into toward the middle of September? Oil prices are down sharply, even as Hurricane Laura came through the Gulf of Mexico at the end of last month and shut even more domestic supply down. So we would, if supply is down so much and then got dropped another 5 or 6% on top of it, why aren't oil prices at least solid, firm, or going higher? Instead, oil prices are dropping. So already we're starting to think 25%. Those are historic levels of oil production cuts, and yet oil never really got that much farther than lower 40s, and now it's into the mid 30s again. So that's one thing. I think the more important part of it is contango, which contango, for those that are not familiar, we talked about this before on this podcast, going back to the negative oil price back in April, whenever that was. A contango in the futures curve is, we're not supposed to see contango in the oil futures curve because that incentivizes storage rather than use. It reduces the roll yield and makes it more of a economic profit to put oil, to find storage, pay for it, and put oil away for the future, increasing inventory. You wouldn't expect that kind of a situation to arise again, where we've had 20-25% of oil supply just disappear, just taken offline. Why are we still incentivizing money, or why are we still incentivizing physical crude to go into storage at these low oil prices? And the fact is that the futures curve, despite this constant curtailment of production, never left contango. It stayed in contango the whole way. And as we started to get into before, in the middle of July, that contango started to steepen out again, which was a warning sign that, hey, something's going on here, at least in the oil futures market, where we're incentivizing even more oil. As less oil is flowing, more of that oil needs to go into storage again. So there's, we're starting to get a sense, and the finger is being pointed at the demand side of the economy, at least the demand side for oil, that even though we're cutting back all of this production, the demand is maybe not coming back up as fast as we would like to adjust to it. And we're incentivizing more oil to go in storage because the demand just isn't there. Demand, even though production is down so much, demand hasn't come back enough to rebalance the market, to bring the futures curve back into backwardation.
And it's wild because if supply is down roughly by 25%, then how much further must demand be down? What about inventory for crude oil and gasoline stocks? Is that corroborating what you're seeing in the futures market?
Yeah, that's another alarming thing. So we've had, a fifth to a quarter of production taken off the market, yet oil inventories have remained at historic highs for this time of year. So that's another sign that, look, we're not using as much oil as we want. Even though we've cut production back, it needs to cut back even some more. The futures curve is looking at the situation not just today, but looking at, as the name futures implies, looking at the future situation, saying even more oil going to need to go back in storage, even as we're still cutting supply. So again, it all adds up to this demand imbalance, or persisting demand imbalance, that looks to be something that's going to linger on over at least the next several months and maybe into next year. And what that says is that the economy is not coming back at the rate, at least the oil market needs, to rebalance a much lower level of supply.
And then how does it all tie into the idea of this bottleneck in the middle of September or towards the end of September? Why does the oil market stand out to you as signaling something might not be as great as the unemployment rate, perhaps?
Well, the high-level answer is just simple risk aversion, right? Because if you know that there's a liquidity problem facing you, and everybody knows that there's a September bottleneck, everybody inside the markets knows that, money dealers know that this September low point exists. And so if you're starting to see more warning signs and become more risk averse, you're obviously going to act as if you're becoming more risk averse, which is sell risky assets. You're going to sell whatever you can. If you're a money dealer, you're going to extend less credit. You're going to extend less money than you normally would, because you're seeing all of these signs that say, you don't want to be exposed at this seasonal low point. And so we're starting to see, little nibbles and dabbles of those kinds of behaviors in an important market like oil, which suggests that there's more angst and uncertainty than we would ideally like to see.
And so you start listing at the end of your article, you start listing some of the markets you're going to be keeping an eye on to see if this risk aversion is breaking out across commodities, capital markets, and currency markets. And you say that the stock market seems to have sort of worried lately. The T-bill market is something you're going to be keeping an eye on, as well as certain dollar crosses before you feel like there's something really taking place. And one of those dollar crosses is the Japanese yen. So let's segue to another article of yours. It's called Bottleneck in Japanese. You wrote it also on September 8th. It's at Alhambra Investments. How does the yen tie into our bottleneck oil story?
Well, first, our bottleneck story to begin with is a difficult one, because I'm not really sure that you can tell that it's going to be a problem in advance. So we can kind of see that there's some angst, there's some uncertainty, there's some weird things going on. We could try to make it what we hope is a reasonable judgment about what's going forward. But historically, these things, they just happen. I mean, there's a seasonal low point. We can't look inside the dealer system. We can't look at the Eurodollar and say, what is really going on at any, intraday? What's going on today, and how will that impact tomorrow? We can't really see those kinds of things. So we just kind of have to be on edge about this bottleneck. We know it exists. We see some weird things happening in front of it, but we can't really, there's no signal that says, oh, this is bad. This is going to be, September 2008. This is going to be, repo September 2019 or whatever. There's really no clear way to say this is going to be a bad bottleneck. So that's where we start. But to add to the levels of uncertainty, the things that we don't want to see going into a bottleneck is the Japanese yen. And I think most people might be surprised that if you look at the charts for the Japanese yen, the yen has been rising ever since March and April, which is not what we would want to see, or not what we would expect to see if Jay Powell and his flood of liquidity, his flood of dollars, had actually been a flood of liquidity and a flood of dollars. No, the yen isn't screaming higher. It isn't moving higher. There's nothing that says this is a disorderly thing, but it's moving in the wrong direction from which we would expect this, positive liquidity, highly functioned market that we keep hearing about. This reflationary trend that's supposedly taking place. Instead, the near constant grind higher in the yen is very much like the oil curve staying in contango. So for the last 6 months, when things are supposed to be improving, here we have two very important, very key warning signs that say, maybe not. Maybe things are not progressing the way we want them to progress. And of course, as I've circled here, we also see a bump in July. So something may have happened in July that not only hit the oil contango curve, the contango part of the oil curve, but it also showed up in Japanese yen too, again in the concerning bucket.
And so yes, right now we're looking at a graph that shows the Japanese yen and US dollar since January of this year, 2020. But if you go back in time, the yen started rising against the dollar, or at least stopped falling, I would say October 2018, which is no coincidence. If I remember correctly, that's when gold started to rise as well. There was a big economic dislocation. So in case we haven't mentioned it already, a rising yen is a little bit like a rising dollar, because the Eurodollar system, Tokyo is a major hub of that whole spoke system. And what happens it's just like the rising dollar. You don't want to see a rising yen. It signals disorder. You want to see the yen falling because it's being multiplied and lent out and re-lent out.
Look, Japanese yen, it isn't quite what it used to be, but that's a separate topic. But it is still one of the key indications for what's going on in the global dollar system. And as you were just saying, it provides us with a consistent view. It's one of those reliable signals that tells us, okay, things are turning one way or the other. If Jay Powell had been successful at all with all of the stuff that he has done, this idea of flooding the world with dollars, I don't believe we would see the yen behaving this way. And again, it's backed up by the oil curve and the bond curve and gold and all sorts of other things. So we have a consistent picture that is saying not inflation, not enough economic improvement, because the markets are acting this way, which is the illiquid way, which is the bad way. And now we are 1 week short of the middle, or only a couple of days short of the middle of September, and we're thinking, what is this going to look like? And maybe it's nothing, maybe it's something, but in the bigger picture sense, we're not heading into September with much that's going right.
I know what I was going to ask you here. You, just like how you ended your oil article, you give a list of things that you're going to be keeping an eye on, and you just gave it right now. But one of them in your article that I didn't know what it was, you said JPY and T-bills, okay, and the repo twins. What are the repo twins that you're going to be looking for to see?
Those are the repo twins.
Okay, those
I must
are
have worded it badly. No, it's JPY. The way that Japanese banks procure dollars is essentially to mimic offshore repo trades. So, in one sense, the Japanese yen is a repo indication, as obviously are T-bill yields. And that's one thing that hasn't been a very much of a concern. I think we need to point that out too, is that the T-bill yields have actually risen a little bit here. They're up a couple basis points from where they were last month. So we're not really seeing a massive collateral strain in that sense. So, JPY, oil, big picture sense, the economy's not recovering, but you're not quite yet seeing that show up on collateral and repo and, oversized demand for T-bills. And I think, it's important also to point out that credit spreads, risky credit corporate spreads, haven't really improved either. And that inflection took place, or at least they stopped improving. They stopped coming down. Spreads did, right in the same week as unemployment claims jumped, the same week that contango showed up in the oil curve, and then the same day that JPY, I circled on the JPY chart. So we're seeing in credit spreads the idea, at least the general idea, that things are not improving. Something happened in the middle of July where maybe the momentum of reopening, the momentum of the economic rebound got knocked off stride for whatever reason. Whatever it was, something happened in the middle of July, and over the last couple of months, it's starting to be leak out and become risk averse behavior.
Maybe we're not seeing in the U.S. Treasury market, but coming across my news desk this morning was that the UK 6-month gilt securities were sold negative for the first time with a negative yield, as well as New Zealand's 5-year bond is now trading at 2 basis points above zero. So maybe in other markets we're seeing it.